Oh, good morning, good morning. Here is my Dunkin' Donuts coffee, and it's a little bit earlier this week. You see, the sun is just starting to come up over the Atlantic as the night turns to day. And I am Kenny Polcari, your host of the party, and today is Monday, May 16th, 2022. And what is it that you need to know? Because there is a whole lot going on, right? On Friday, stocks rose after JJ confirmed what we all knew. Now, this relief rally could go on for a couple of weeks, so you just got to sit tight. Do I think the bottom is in? Absolutely not. The weakest sectors led the advance. Why should that be a surprise to anybody? And what are we having for dinner tonight? We're having the linguine putanesca, not linguine putinesca. That would be a whole different recipe. Anyway, over the weekend, I was on Fox Business with Maria Bartiromo on her Wall Street Week. You can find the link on my Twitter account. You can also find it in my Daily Note if you get it. If you don't get my Daily Note, you should subscribe to my Daily Note, right? It's a freebie. It's out there. I give it to you so you can get all the information. Anyway, volatility continues to make the hair on the back of your neck stand up as the algos pushed the S&P to within a chin hair of a 20% drop on Thursday, right down to 3,800. Which would signal a real bear market. And that would have put Wall Street on the cover of every major newspaper around the country, never mind the field day that the cable news channels and the social media outlets would have. Now, S&P 3,800 was clearly in the bullseye on Thursday. We traded as low as 3,858, leaving just 58 points between correction territory and bear market territory. The concern was, how would the algos and investors react if we went there? Would the buyers defend that position, or would the algos go into this frenzied sell mode as another technical breach would ignite a wave of sell orders, allowing buyers to step aside, leaving a void in bids, sending sellers into panic mode, which would push prices lower, send the indexes further into the abyss? Well, good morning, boys and girls, because we don't need to worry about that at the moment. Because stocks bounced on Friday, and what many are describing as a relief rally from a very short-term oversold position. By the closing bell on Friday night, the Dow added 466 points, or 1.5%. The S&P up 94 points, or 2.4%. The NASDAQ raced ahead. It was clearly the most oversold by 435 points, or 3.8%. The Russell gaining 54 points, or 3%. The transports added 137 points, or just 1%. 10-year treasuries ended Friday yielding 2.9%, up 7 bips. This morning they're trading right there again. Now 3% seems to be the level to watch. Last week we tested 3.2% and failed as talk of this looming recession is now dominating the conversation. I mean, even JJ so much as admitted that last week, and now Lloyd Blankfein, the former CEO, is saying the same thing, tossing in his 2 cents, saying that he thinks we're on the path towards recession and the ability to avoid one is quite low. The VIX last week on Friday fell 9% to end the day at 28.91. Well below that 40 level that many analysts think is the level to watch that's going to ignite more of a capitulation in stocks. And with U.S. futures a bit weaker at 5:30 this morning, the VIX is up just 50 cents or so at 29.40, still leaving us smack in the middle of the 25-35 trading range that it's been kind of stuck in during these last couple of weeks of volatility. Oil rose 4% on Friday to end the day at 110.40. Hello, what have I been telling you? I think right now the range is 100 to 113. A breakout at 113 is going to take oil right back to the March highs of 120. This morning, though, traders are locking in some profits after the surge on Friday, sending oil down 50 cents to 109.90. Means nothing, because the global supply is about to be challenged as the European Union begins to phase in their ban on Russian supply, and OPEC says they are not able to make that up. Now, everyone trying to pinpoint the reason why the markets rallied hard on Friday. I would argue that it was the admission by JJ that he now sees a difficult but not impossible path forward, that he suddenly realizes that he will not be able to engineer the soft landing that he kept telling us was possible. right? And that while he expects these 250 basis point hikes in the near future, he is no longer committing himself to that narrative. He has opened the door and admitted that it might be different, and it will come with some additional pain. Oh, and by the way, we should have begun raising rates much earlier. I mean, really? You can't even make this stuff up. Who would believe it, when they say it? It's absolutely crazy. In any event, the admission that this is the case did what exactly? Well, it offered clarity. It revealed what we all knew, that the old narrative was fake news, and that the recognition that it's going to get tough is what investors needed to hear to confirm their own suspicions. Remember, when the news is unclear and left to interpretation by the markets, the obvious move is to overreact so that the buyers take control. They step back, forcing sellers to push prices lower and then lower again. It becomes self-fulfilling. Markets are expected to weaken, so they do because lack of clarity, blah, blah, blah. But on Thursday evening, after JJ was reconfirmed by the Senate for another 4 years in the job, he suddenly got the courage to call it what it is, a serious situation, and one that even he is unsure of, which means you can only imagine what the others on that committee must be thinking now, right? But it was clear that we're going into a recession, and that's what the markets needed to hear. Now, to be clear, that's not a bullish news. It's not bullish news. Nor was the eco data that saw consumer sentiment plunge to the lowest level in years, right? It fell to 59.1, well below the expected 64. One-year inflation expectations remain at 5.4%, which also appears unrealistic, considering that it's currently running at 8.5% on the official scale and 10% on the unofficial scale. But his announcement was honest, right? He admitted that he's behind the eight ball, and investors and markets can handle the honest news, whether it's good or bad, so that investors can reassess and reprice the risk. It's not rocket science, it's just a math problem. And on Friday, everybody recalculated the math problem, which allowed for the relief rally to take place, at least in the short term, putting sellers now in control, leaving a void in supply, causing buyers to have to reach for stock, and that sent prices surging. The weakest sectors all year long that we've been discussing were the best performers. That should not be a surprise. They're down 70, 80%, some of those names, right? Tex, XLK, that's down 22%, 23%. That rose 3.3%. Communications rose 2.5%. Consumer discretionary rose 4%. Retail rose 3.3%. Financials rose 1.5%. Industrials up 1.3%. Real estate up 2.5%. ARC, disruptive tech, rose 11%. Semiconductors, SOXX and SMH, both rising 5%. Cybersecurity names rising 4.5%. Artificial intelligence names rising 5%. And the list goes on. All of these sectors are down double digits, with some whole sectors off more than 40%. And the names that have been outperforming all year continue to outperform. Energy up 3.7% on top of the 42% gain year to date. Consumer staples up 1.5%. Coal stocks like BTU gained 6% on top of the 100% gain year to date. Basic resources, mining, names like XME and AMR gaining 3 and 4.5% respectively on top of the 9% and 150% gains. And as you would expect, the contra names, meaning going short the market, got slammed, with SHPSQ and DOG down 2.3, 3.6, and 1.5% respectively. But it ain't over yet. Now the question is going to be, okay, JJ, we get it, tough times. Now just how deep is a recession going to be? That's going to be the next question, right? And that's going to be the driving force for the markets over the next couple of weeks, if not months, because some people will think it's going to be a deep recession, which is going to cause much further pain and downside for the markets, while others are calling for a more mild recession, right? So maybe less downside. So depending on where you stand in this argument is going to drive what you expect future valuations to be. And that is what creates a vibrant, healthy market. When buyers and sellers have the different opinions, it causes this yin-yang, right? Eco data today includes the Empire Manufacturing, right? The expectation of 15, which is down from 24.6 last month. Tuesday's going to give us advanced retail sales of plus 1%. If you take out autos and gas, up 0.7%. Industrial production of up 0.5%. Capacity utilization at 78.5, inching closer to that 80% number, suggesting higher inflation. Wednesday's going to give us housing starts, expectations down 1.8%. Building permits down 3.1%, and then existing home sales on Thursday down 2.5%. Note that the housing numbers are now going negative. You have to think about mortgage rates, which have surged by 80% in 5 months, going from 3% in January to 5.4% this week, which just means that the cost to carry has increased, and that should begin to weigh on housing prices. Over the weekend, we heard that Vlad might be suffering from a deadly form of cancer. We can only hope that's the case. But in any event, his invasion of Ukraine continues, and this is going to continue to weigh on investor minds. But it's going to continue to be a subplot, though, as it disrupts global commerce, global energy supplies, and food supplies. What is new to the conversation is that both Finland and now Sweden are now pushing for NATO membership sooner versus later. And many now wondering what will Vlad's reaction be now, as he has already warned Finland that they will be hell to pay if they proceed with the NATO membership. Can you imagine what he's going to say now that Sweden pushes as well? That's going to be, that'll be another geopolitical crisis. COVID is no longer the enemy it was, other than in China and North Korea. The world is learning to adapt and do what's necessary, but supply chain problems will continue to exist because so much of what we import comes from China. I'm hoping now that we're going to smarten up and find other sources of manufacturing, which include, by the way, manufacturing right here in the United States. That's a novel idea, isn't it? Okay, so this morning, U.S. futures are down. Dow futures are flat. They're flat. They're down 1. S&P's down 9. Nasdaq's down about 50 points. Russell's down 6 points. It is the last week of earnings, and we're going to hear from the retailers like Home Depot, Lowe's, Walmart, Target, etc. They should provide good insight into consumer attitudes in the face of rising inflation. I would expect that the consumer staple names will perform well. They've got pricing power, and they're also staples. I would suspect that consumer discretionary names might be under a bit more pressure because you can eliminate the discretionary stuff, right? Cryptos, which have gotten completely hammered over the last couple of weeks, stable coins, Lunar, and now Terra USD have gone belly up. I just wonder what Mikey Novogratz is going to do with that huge Luna tattoo that he had seared on his bicep. Anyway, that's another story. Naysayers are calling for the demise of the whole asset class. Bitcoin and Ethereum continue to struggle, and they remain under pressure. This morning, Bitcoin is trading at 29,500. Ethereum is trading at 2,000, down 57 and 47% respectively from their highs. And no, I am not in the camp that cryptos are anywhere near dead, but I am in the camp that they are still very much in their infancy, and they are long-term plays, period, the end. Stop whining about it. Now, while the S&P and its brethren had a good day on Friday, many are asking if that means the lows are in. I would say probably not, but the rally could go on for a couple of weeks and see us retest somewhere in the 4,200, 4,220 range, right? That's where you run right into the downtrending trend line. I would also expect to see any advance led by the way oversold names like we saw on Friday, and I would expect to see the trader type sell into that as they rally harder. I would then expect to see the coming sell-off to be led by those same names. The actions will be driven by macro inflation data that we see. So could the S&P test 3,600? Sure it could. And you should prepare for that and then be pleasantly surprised if it doesn't happen. Remember, 3,800 would represent a 20% decline. 3,600, a little bit more. In the end, for the long-term investor, it means you remain focused. You look for the opportunities created in all this chaos and stick to the plan. Investing doesn't mean you day trade. That's called day trading. But building a cash position and being patient is a way to go, and it is a strategy. It allows you to sit back, analyze, and then make methodical, appropriate decisions. Sometimes doing nothing is actually doing something, right? You don't feel forced to do anything. In the end, investors need to prepare for more turbulence ahead because stocks are going to continue to thrash around until valuations get to be more attractive and there's some more control over the economy. And while stocks are starting to look attractive for longer-term buyers, the risk to the downside is still very real. So patience here is a virtue. Okay, so what are we having for dinner? We're having linguine putanesca, not linguine putinesca, like Vladimir, right? This is by no means a nod to Vladimir Putin because that would be a very different recipe with very different ingredients. This one is so delicious, and it's easy to make, quite honestly. It doesn't take a lot of time, and it smells delicious, right? But this is a nod to the Neapolitan dish. This is where this dish was born, right? It's very hard to find this dish in one of your local Italian restaurants. For some reason, not a lot of places offer it up. Not sure why, but it is delicious. The word puttanesca translates into the style of the prostitute, where the Italian word puttana means a lady of the evening. It's made from tomatoes, black olives, or you can use Kalamata olives. Don't combine them. You need capers, anchovies, onions, garlic, oregano, and parsley, right? It's easy to make, but even more so, it has a really interesting history, right? And so many wonder, how did this dish become so popular, actually? And as you might imagine, legend has a number of explanations, right? The first one was the intense aroma that it has when you're cooking it would lure men in from the street into the local brothel where the prostitutes would be cooking the sauce to lure in their patrons. Or the prostitutes made it for themselves to keep the interruption of their business to a minimum because it's an easy dish to create. So you can make it quickly and have it over there and you can run right back and have a dish. And in another twist, it was a favorite of married women who wished to limit their time in the kitchen so they may visit their lovers while their husbands are out hard to work. Whatever its origin, it doesn't make a difference. It is a great dish. It's spicy, it's tangy, and it's vibrant. And it's an appropriate description for the market that we're in today, right? The market is spicy and tangy, and at times can be vibrant, while other times not so much. Now, you want to start with 3 crushed garlic cloves, sauteed in olive oil about 3 to 4 minutes. You don't let them burn. You know the drill, right? Just saute them around. Next, you want to add in a diced white onion and diced minced anchovy fillets and saute for 5 to 8 minutes. Look, the fillets just disappear anyway. They just melt, right? So you don't have to worry about it. There's just a hint of a flavor. Then you want to add 1 can, 28 ounces of kitchen-ready crushed tomatoes. Not puree, just crushed tomatoes. Then add about 1/4 can of water. Let it simmer for 10 minutes or so. Now add the capers, oregano, pepper, chopped Italian parsley, and rough chopped pitted Kalamata olives or the pitted black olives, whichever you prefer, but don't mix. It's one or the other. No need to add salt right now because the anchovies are very salty, and if you take a bite first, then you can take a test it. And if you need to add salt, then do it. But don't be so quick to add salt. In the meantime, bring a pot of salted water to a rolling boil and add the linguine or the spaghetti, whichever you prefer. Let it boil for 8 minutes until it becomes al dente. Remove it, drain it, always keeping some of the pasta water, right? A mugful, 2 mugfuls, whatever. You want to add the pasta to the saute pan with the puttanesca sauce, heat it up and stir it so that it's well coated and fragrant. You want to serve this immediately on warm plates, offering up the Parmigiana cheese on the table. Do not add the Parmigiana cheese like I usually do while it's in the pot. Leave that on the side and let your guests decide if they want, in this particular dish, if they want Parmigiana cheese. Now, if they're smart, they will add the Parmigiana cheese because it is so delicious. Because you know me, I put cheese on everything. But one way or the other, don't add it directly to this dish. Leave that to your guest, your family or your guest to decide if they want. You can have this dish with a glass of red wine, not a heavy red wine, but you might want a Chianti or a Pinot Noir, something that's a little bit lighter, not so heavy. This dish, the whole thing should probably cost you, I'm guessing, $30 max by the time you buy everything. To serve a family of 4. So it's economical, it's easy to make, and it is so delicious. It is Monday morning. Get ready for the week. Until tomorrow, take good care.